Thank you. So we're going to talk about, we want to make a lot of money together and then help the world. So as we make a lot of money, we need to allocate. We heard some of those themes already. So I have some perspectives from the venture world with Jason in early stage. Stephen Burke, he's our Cal Ripken. Every week at 11 o'clock Eastern, we have a briefing, and we learn from Stephen has a comment, a set of slides, not just comments. And it happened in London. And actually, Rich Sobel was like, why don't you have Stephen Burke talk? Someone besides you. So that sort of, I have to give Rich Sobel. Rich Sobel has been running a family office, allocating, and he also has a transatlantic perspective. And I think Chris, my fellow Michigander from Allstate, I don't see you here, so we won't have his perspective. And Manish said he was a game time. So you guys actually helped me catch up on time.
We'll see.
Yeah, we'll see. Stephen Burke, just quick intros, and then, it's sort of like, again, what sort of scares and excites you as you allocate. Go for it.
So thanks for the introduction and for the opportunity to speak every week and to prepare for it. I appreciate that. I run a long-only and hedge fund firm out of New York. We are a high-conviction manager. Sorry, that's the first time people couldn't hear me. We're a high-conviction shop, and we really focus our investments on the macro themes that we think are the best opportunities and then tying them with bottom-up research. So we'll talk a little about that in a minute. Jason.
Good afternoon. Thank you for having me here, Mark, and 361. My name is Jason Jacobs, and I'm the managing partner of Propellant Ventures. We are a seed-stage venture capital fund here in Chicago. We focus on pre-seed and early seed. We're generally one of the first VCs in a round, and we're focused on B2B technology-enabled companies throughout the Midwest. And I've been very active in this community for over 20 years. I also run the Founder Institute chapter here in Chicago. We help people launch seed-stage technology companies. Glad to be here.
Thanks, guys. Mark, thanks for inviting me. My name's Rich Sobel. I'm a private capital investor, managing partner, co-managing partner of Virtu Capital Partners. For the last 7 years, I've been managing a private family office of European, Russian capital, allocating to different asset classes. Late last year, I teamed up with Eddie Vanderpart, another 361 member, and we formed Virtu to invest in mid-stage emerging companies in the technology and impact space, small private equity deals alongside other partners, and to a limited extent backing emerging managers, all with an impact technology focus. So I wear two hats. One is I continue to advise some select number of family offices on allocating capital. That hat is getting smaller, and the bigger hat is investing in impact investing and sustainability.
Actually, we met in Russia, cut our teeth. And I call Rich the godfather of private equity in Russia in many ways. So did you have that lunch that you were going to have?
Yeah. But, when you talk about Godfather in Russia, it sort of scares people. So.
Right as Simon walks in.
Oh, yes. Right on cue. All right. Sorry. Go ahead, Stephen.
So, talking about asset allocation, right now there's a lot of distortions, distractions, and some disruption going on in the markets, and we got a hit with that with the Evergrande issue popping up this week, which ironically shouldn't be a surprise to anyone. It's been a slow-moving, traffic accident, train wreck coming. The real estate sector in China was 29% of GDP before this week, so it's not an immaterial area. So whether it morphs into something bigger, the actions today seem like it won't because the government's getting involved in it. But we have to keep an eye on all the different inputs that are coming in, and there's just a lot of noise right now in the near term, and I think the way people are going to be most successful investing and allocating going forward is to look past the short-term noise, which there's going to be plenty of, whether it's D.C., trying to get the debt ceiling raised or try and get an infrastructure plan or their social human infrastructure programs in place. There's a lot of noise out there in the markets, and what we try and do is step back and look a little past that. So what excites us right now and has excited us for some time is the digital transformation that is going on. And everyone's like, well, yeah, of course it's going on. But, you know, we've been talking about 5G for years now. We've been talking about blockchain for years, but we haven't really seen the benefits of them because 5G rollout is just really starting to take place and other technology advances. So in our view, the excitement is coming from the transformation that's ahead of us, which we think is going to rapidly pick up pace and create massive new opportunities and big new total addressable markets. And I think the issue of the new total addressable markets gets a little bit overlooked by all the stuff that's going on, except in the private sector, in the private equity and venture area, where you're really focused on that primarily. But there's still a lot of that we keep saying, yeah, it's not here, it's not here yet. So we're very excited about the digital transformation for two reasons. One, the new opportunities it creates, but also we think it has a very big impact on lowering the inflation that's in the system. And we've seen that in the U.S. already. In the last couple of years, the digital economy has grown to about 8%, 10% of the U.S. economy. That's through 18. If you fast forward through 21, we think it's probably between 12 and 15% and continuing to accelerate. So we think this is one of the big changes, and we just think that people have not really come to grips with all the things that are coming, and that's creating big opportunities, whether it's in cybersecurity, whether it's in the cloud. I mean, the transformation in the cloud is still only in the early innings, and when that really hits with 5G and AI and then add quantum to it, we think the rate of change is going to accelerate to a level that will be somewhat bewildering for people. So you actually have to be ready for it now for what's coming down the pike, because it's coming very fast. What both excites us and scares us is the current interest rate environment. And it excites us because, one, it gives you a lot of opportunities to make a lot of money. What scares us, though, is it can't go on forever. And when you start to have the directional changes coming, we're going to see a lot of people who are overexposed to their debt levels or their leverage that they're not really prepared for. And so it's got a blessing and a curse kind of element to it because we haven't traditionally around the world used debt well. And just to put it in perspective, I mentioned this on Tuesday, since the financial crisis, global debt has grown from about $205 trillion to about $296 trillion. So we solved the debt problem by taking on massive amounts of debt. And when that bill comes due, we're going to have to worry about that. And that's really what keeps us up at night, is the bill coming due for the debts that's outstanding, because we keep adding to the debt. And if we don't get it accelerated at a rate that we want to, with the growth coming that is being promised from all the spending we have, we're going to have a big problem. And if you think Chicago has a problem, think of the world with a GDP that's around 90 trillion and global debts at around 300 trillion. The math doesn't work very well for long if you don't get the growth to stay ahead of the interest rates. And there's a chart here that I was going to show, which isn't coming out very well. I know it's up, but the point of this chart is back in 2000, we had about 5 trillion of debt, I believe is the number, 3 trillion of debt, but our interest costs were only 223. We are now closing in around $29 trillion of debt, and our interest costs for last year were going to be around 303 for this year is what it's being targeted. And that means that if we have any kind of move up in rates back to where we were in 2000, we would look at adding probably $1 trillion to our debt interest cost servicing. If we only go back to where we were in 2005, you'd add another $300 to $400 billion of interest costs that have to be financed. We're having trouble coming up with the numbers as Olga was pointing out. What they're trying to do to come up with numbers to offset this just isn't going to work. It's going to create a burden on states like New York, New Jersey, Illinois, because when you add up the combined tax levels, it's way beyond what they're proposing. So that's what scares us when the bill comes due. So I'll stop there and turn it over to you.
So my perspective is on the venture capital industry, especially here in the Midwest region, so I'll speak from that perspective. As we all know, venture capital in general has exploded over the last year and a half. The pandemic was actually really good for the technology industry. A lot of things got accelerated. A lot of capital is out there. And certain industries like insurance tech, property tech, started to accelerate their innovation, just to continue to grow their industries. So the Midwest region specifically has the highest investor returns out of any region in the country. We also have Chicago specifically has the highest returns out of any city in the country. We have less deal flow and less deal count here, but when you look at the numbers, we have the highest returns. So it's a great region for innovation. We have a lot of industries here. Some of this was mentioned before, but we have, in Illinois alone, we have third highest, or Chicago specifically, third highest, public school system in the country. So we have a lot of innovation, around a lot of smart people here. We have the second highest per capita out of any universities in the country outside of Boston. We have some of the top tech talent in the country. Our universities produce some of the highest tech talent. We have lots of Fortune 500 companies here. So doing business in this region is really good. There's a lot of innovation. And the venture capital industry, specifically here in Illinois, the Q1 of this year was just about the same amount as all of 2019. And 2020 was a record year. First quarter was a challenge for everyone, but after that it exploded after things started to settle down with the pandemic. And so there's a lot of innovation happening here. We, as a region, are very diverse. We're not a one industry economy. Like out in the valley, it's a lot more tech focused. There's other stuff there I know, but we have a lot of industries here. Manufacturing, we've got financial. The food business is extremely hot, big here, especially here in Chicago. But we have insurance. We have a lot of insurance companies in the region. So there's just a lot of great reasons to do business here, and cost of living is very reasonable. You have companies from around the country, especially on the coast, that are coming to do business here, move their business here, because the talent is a lot more affordable here. The cost of living in general is more affordable. So there's just a lot of great reasons, and we've had a lot of new funds that have been launched in the last 5 to 7 years. We still have a shortage of capital here. We need more capital here in the venture space, but either way, there's been a lot of great efforts. You'll hear about some of the efforts later this afternoon about the impact side of investing into underrepresented founders and their companies. We have a lot of those efforts happening here in the region as well, and I know across the country, but my vantage point is really here in Chicago and in the Midwest, and that's why we're focusing our fund in this region, because there's just a lot of great opportunities here. So good place to do business, and so I'm excited about what the future holds here in the region.
So I'll add my comments that will repeat a little bit some of the other comments and hopefully extend them. But I was in my capacity as doing asset allocation work at a conference earlier this week, and I had a chance to hear a couple of prominent speakers. One, Gillian Tett from the Financial Times. She offered some thoughts that I think are worth thinking about, which is basically that we're in a new territory. And she's written a book apparently about this that's coming out. But the volatility is not in most business plans, and it's not in most kind of economic models. It's volatility from climate change, from rising populism, social tension, medical pandemic, cyber issues, geopolitical issues. And so as you think about risk and you think about investing and asset allocation, she argues for a new model, more lateral thinking, more, getting away from tunnel vision. And I think for me, coming to conferences like this and earlier in the week, the key is talk to as many people who have different opinions as possible, because we all suffer from this notion of groupthink, where we reinforce each other's hypothesis and we end up having blind spots. Problems that happen in faraway places can now very quickly, through contagion, end up being right on your lap. So, I personally think the environment with practically zero interest rates, lots of growing debt, money supply, and tensions around the world in places like China and the U.S., this creates potential for greater volatility going forward. And so the environment for asset allocation if one is complacent, it's quite easy. Just, keep putting money back into equities, private and public. That just keeps working, but at some point it won't work. So one has to really look more closely in asset allocation, understand your own risk capacity, your liquidity needs, and so that's what we try to advise and try to think about. What are the things that really scare me? Well, inflation, potential for rising interest rates, taxes, government deficits. Private debt bothers me a little less than public debt because the public debt at some point is going to crowd out social spending on things that are so desperately needed. So that could very quickly catch up with us. Lack of leadership at the federal level, the inability of the government to come together to solve problems. I mean, how does Chicago or Illinois or Atlanta solve their problems when the leadership in the federal government is so, poor? I also think that fixed income, most high-quality fixed income is a terrible place to be. If you're in cash, other than what you need for spending, or in fixed income, you're losing money on a real basis. And I'm one who believes that there's going to be inflation for longer than we think. So that debate about how transitory is inflation, my hunch is that we're going to have inflation for a while. What they taught us a long time ago is when you print a lot of money, it ends up flushing through in rising inflation. But there are things to be excited about. So the problems create opportunities, and I would echo what Jason was saying, is that there is a whole new wave of entrepreneurship and new businesses that are being created. So someone who's worked in emerging markets in Russia has seen the rule of law increasingly come to mean very little. Protection for investor rights hasn't really stood the test of time. The United States, I like investing here better than in emerging markets at this stage. I don't see that changing. I think this is better risk. There's a lot of talent here. Private credit and private assets is where we're focusing a lot of time. For instance, somebody said the other day, businesses over $100 million in equity value. There are 2,600 businesses in the United States that are public and 17,000 businesses that are private. So there's much more value and much more to choose by looking in the private markets for interesting situations. So venture capital, we're particularly excited about things that have an impact aspect to them. We think that you don't have to invest in concessionary projects, and there's a lot of talent mobilizing to go into things like innovative food and education. And we've identified managers and entrepreneurs who are able to make money in these spaces. So I think you have to be selective. You have to be close to the businesses. These are not passive situations. One other thing, I was of a mind that real estate would be a nice place to be, maybe not retail, maybe not office, but at this stage of the cycle, you can look for value in real estate. However, real estate is not a simple place to invest. So when we look for opportunities in private equity and real estate, I think you again have to be selective, and you have to back managers who have a long-term track record and a very kind of disciplined, carefully thought-through strategy, because it's not clear how real estate is going to play out. It's not clear how the future of office is going to play out. Why does the U.S. have 20 times more retail per capita than most of the European countries? I mean, we're over-retailed. So these things are going to change over time, and a lot of money is going to be lost if people aren't careful. So those are some thoughts about what excites me and what scares me.
Rebut any of that, Steve? He's basically saying he loves private over public where you are.
Actually, the small cap area he was describing, there's no difference in a lot of them between being public or private in terms of both the opportunity and the return. The only thing is they're paying a lot more than they thought they were going to be public than they had originally planned. So we do see a lot of opportunity there. I think one of the points Rich made is really important is that the changes that are going some of them are subtle, and people are waking up now to China slowing down, but China's had a planned slowing for several years. they've been trying to manage their economy down because they knew they couldn't grow at 10% a year for forever. So some of this is normal, but if you're not adjusting your thinking to the slow-moving stuff, only focused on the fast-moving, you're going to get caught in big surprises. I think the other point that Rich made is there's a balance between the public and privates that liquidity plays a big role, and I think the tables turn too far, swing too far to one way to the other. And I think making sure you have a portfolio that is balanced with the right liquidity to get you through the problems that inevitably come because the world is messy. And I think you have to be ready for that. And I'm not sure the way people have been investing lately at zero interest rates reflects the risks that are out there. So I do think, managing your liquidity and managing what happens in a higher rate environment, because rates can stay low for a long time. Japan showed that, but it hasn't been a great place to invest until recently. So you have to look at these things in context, not just what's happening right now, but what the trends are. And I think that's a key element.
So question from Sam. You can introduce yourself if you can.
Hi, Sam Cashy with Armanino. How do you consider diversity and investing in minority-led businesses, black, brown, women-led organizations? And please comment on what your percent of your current assets are in those today. What will be that allocation by 2026? And what's your plan to get to your objective?
So, we've invested in a fund in Boston called One Way Ventures, which backs first-generation immigrant founders. So we consciously allocated to a manager where their criteria includes, it's not only founders who are immigrants, but one of the criteria is that at least one of the founders, principal in the business, has had to be born in another country, buy a one-way ticket to the United States. We are grossly underinvested in minority and women-led businesses. But I can tell you, today we were involved in a situation where we're working with a woman manager who we're going to invest with, who's bringing us a very interesting healthcare deal. And so I think that this is a direction we would like to do more. I don't have specific metrics or timetable, but it's something that I feel we can all do better, and it's important to me. So I'm glad you raised that.
We're still building our venture capital fund, but we've made 4 investments, and 100% of our investments are with diverse founding teams. So we're proud of that fact, and it's something we'll continue to look for in our companies. Personally, I'm involved with, as I mentioned earlier, the Founder Institute, and we have such a diverse group of founders. So at least 10 years, if not longer, I've always surrounded myself around diverse founders. So it's just part of the work that I do here in the city and something that we will continue to look at. I'm not going to tell you that 100% of our companies will be from diverse teams, but it is something that we look for, and so far we have a pretty good percentage, and it's something that I do believe in as well. So
it's something we believe in as well, but we're victim to the availability in the public markets, which, as we know, has been underwhelming in their ability to put women into leadership roles or even supporting them in starting public companies. So we'd love to do more in that area. The one comment I would make, though, on the whole impact ESG and all that element in the public markets is watch the hype, because most companies don't know what they're doing right now with it. There's no real good rules for the road, and I think most people who are saying they're doing it right now are pushing the edge of intellectual honesty. The public market is what it is, and unfortunately, it's a reflection of society. So until they get society more on board, we're going to have that problem. But I would really, I think the rules are far out from getting the right rules of the road for companies and managers to work off of. And I think once we get a clear mandate, one mandate, not, Rodrigo, how many was it, 20, 30 different ESG standards, or, and so we need a better roadmap for that, for all of us to do a better job in that area. I think that's going to be a key element of it.
I'd like to just add one other thought that I noted to myself before I came up here, and that is things in the blockchain. So what excites us is that I think I'm going to have a hard time explaining this because I'm not the expert, but we've identified some people who we have a lot of confidence in. We believe they've figured out where the blockchain is and where it's going, that we've reached an inflection point where that kind of early stage has now reached a stage of adoption that makes it here to stay. And it's still early innings, but I think that these technologies, they should not be dismissed. And so earlier this week, I was listening to some other very smart people who are putting a small part of their capital into this with the notion that, this is going to be here and grow and represent a bigger part of the economy, although it may take longer, but it's coming at a very fast pace. So I think in terms of an area that we plan on spending time trying to figure out and try to get access to, and that I think holds tremendous potential.
Well, that segues us to fintech, but I just want to make a comment on your question, Sam. So I think what we're trying to do with 361 is to be a lot more intentional. 3 years ago, we had an impact conference. The question was, how do you define impact, all the rest, but what I decided in March that we're going to measure ourselves. So what we do, we raise capital primarily, right? So I think we raised as a platform $1.3 billion last year. And so we're trying to widen the funnel of funds that represent diverse fund managers and women-led and black and brown, and we have to look at also our community, the people that are even here. We have a nice white male panel. They're very smart. We're trying to do better. And I actually, but the point is, just as Lauren, wherever he is he keeps on bringing great introductions to people like Dory. But I'm looking we're in the South Side, so we're looking for more deal flow where you can sort of see it. And for the community, it's all for all of us to. This is your community. This is not mine. This is not Salt. This is not Milken. This is us. So let's leverage each other and help each other on this point.
Come join our 361 Firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.